Let's get more from Matthew Huang. He's Asia currency and rate strategist at Macquarie Group. Matthew, thanks for joining us. Well, why do you think that?
Thank you, Rich. I think, in terms of what we've seen over the last, it's really only 3-4 days since the S&P downgrade. It's only solidified people's views that that there really is a need for a global reallocation and rebalancing. And so we're, the main beneficiaries of that reallocation to this region, I think, will primarily be Singapore, Malaysia, Korea, and Indonesia. They've already seen a lot of foreign inflows over the last couple of years, and I think that trend will continue.
I was just talking to Haslinda about the strength of the Singapore dollar. That's got to be off-putting some people from investing in case they actually see it move down, and then they lose, of course, money when it happens.
Well, I think one thing that at least I've learned looking at the Singapore dollar over the last 3 days, since Friday, is that its resilience. You look at how much asset prices adjusted globally, primarily in equities. That was mainly equity-led. The Singapore dollar at its peak was only down maybe 0.7%. And it's regained a lot of those losses even today. So its resilience in terms of selling in the midst of a global crisis is shown to be quite limited. It was met with quite a bit of buying as well. And so I think those type of trends actually reconfirm the fact that people are becoming more comfortable with Singapore, and it should be the safe haven for Asia.
So I guess we'll see more ringgit strength as well, won't we, if we get Malaysia being a beneficiary of these inflows. I suppose also a lot of this is Islamic capital markets too attracting attention.
I believe so. What we've seen is we're seeing an increased relation between the Middle East and in Malaysia, being the largest sukuk market in the world. Not only on the portfolio side, but on the deal side, you're seeing an increased number of announcement of joint ventures that are being opened there, and money that's being invested into the region from that. It's just natural to assume that in this global environment where you have to think people are generally overweight dollars still, where they're going to put the next marginal dollar. And I think for the Middle East, Malaysia is a very natural and easy destination for that to occur.
Right, so what do people invest in if they're coming into Singapore and Malaysia? We talked about the capital markets there, the Islamic capital markets, but what else can you invest in Singapore, for instance?
Well, my primary focus is really on the rates and FX side. And if you look at global fixed income portfolios and where we're coming from, again, there really is a need for reallocation. Generally, prior to the crisis, portfolio allocations into emerging markets were at most maybe 1.5 to 3% is my rough estimate on that. And that's roughly in line with the size of the markets relative to global market sizes. That allocation is just simply too low. If you look at what's going on in Europe, what's going on within the U.S., these money managers, there's still a need to reallocate their monies more broadly outside the U.S. So I think non-U.S. high credit-rated countries and assets will continue to perform well as a result of this reallocation. Yeah,
Matthew, and as you are talking about rates here as well, and we're talking about the fixed income markets, at the moment, do you think that we're on top of the interest rate cycle, or do you think we have to have more normalization in the pipeline? And I'm particularly talking about Malaysia and Singapore.
Well, I think in terms of the interest rate cycle that we're seeing, over the last couple of days, the reaction within the U.S., and these markets, just to a large extent, still do follow the U.S., it's really been a huge panic, and the market's not really knowing what to do with themselves. And the downgrade has never happened before in the history of financial markets. And so people are looking at this, and the first thing they do is they're going to run into what do they feel comfortable with. This is a scary environment. You don't know what's going to happen. People don't know what is going to happen. And like my 3-year-old daughter, if something scary happens, she's going right to her blankie, And if Cameron Leslie, in a very scary scenario, he's going right to the gym. He's doing 165 kg bench presses. People are going to do what they feel comfortable with. And Treasury market is exactly what happened. You look at where Treasuries are today and how much they've rallied. You compare that to where the tips are at. The real yields on those are nearing 0%. Now, as much as the U.S. is slowing down, we're not talking about 0% growth. We're talking maybe 2% on the low side. And so the cycle has really been pretty far advanced of itself, I think, just due to the extreme market reaction over the last couple of days. So over the next week or so, I think. Yeah, go ahead.
Matthew, we're out of time, I'm afraid. But thank you so much for joining us, Matthew Huang there. And if you're an investor